Picture a brand new Lamborghini Urus or a Bentley Bentayga parked outside a small office. Not a low two-seat sports car. These are the big, heavy SUVs. Most people walk past and see the same thing. Someone showing off. But the person who bought it isn't thinking about how it looks. They're thinking about their taxes. Because to them, that car isn't really a purchase. It's a deduction. A way to take money they'd owe the government and keep it instead. And here's the strange part. Those heavy SUVs, a business owner can write off almost the entire cost in a single year. But a low, two-seat Lamborghini parked right next to them. Same badge, similar price, barely qualifies for anything. Same brand, same driveway. The difference isn't how much money they make. It's the weight of the car. So why does the government practically reward you for buying the heavier one? How do the wealthy turn a car, something that's supposed to lose value, into one of the smartest money moves they make? Let's follow the money. Start with two people buying the same car. Same model, same price, same dealership. The first is a regular salaried employee, someone whose paycheck arrives with the taxes already taken out. When they buy a car, they're spending what's left over. Earn the money, pay tax on it, then buy things. That's the order almost everyone lives with. The second person owns a business, and for them, the order can flip. A business gets taxed on its profit, what's left after expenses. Every legitimate expense shrinks that profit, and a smaller profit means a smaller tax bill. Run the same income through both orders, and the gap isn't small. It can be tens of thousands of dollars, kept instead of paid. So here's the question that changes everything. What counts as a business expense? Computers do. Machinery does, and under the right conditions. So does a vehicle. If a car is genuinely used to run the business, the tax code can treat it like any other piece of equipment the company needed to operate. The moment a car becomes equipment, two powerful tools switch on. One is a part of the tax code called Section 179. The other is called bonus depreciation. Together, they decide how fast that car turns into a deduction, and in some cases, the answer is almost instantly. Normally, when a business buys equipment, it can't deduct the whole cost at once. The tax code assumes equipment wears out slowly, so the deduction gets spread out. A slice this year, a slice next year, over 5 years or more. That slow drip is called depreciation, and it's slow by design. Section 179 is the exception. It lets a business skip the waiting and take the deduction up front in the first year. In 2026, a business can write off just over $2.5 million of equipment this way. A figure the 2025 tax law made a permanent part of the code. Then comes the second tool. Whatever Section 179 doesn't cover, bonus depreciation can. And in 2026, bonus depreciation sits at 100%, meaning the entire remaining cost can be deducted immediately, stacked right on top of the Section 179. Picture it as a stack, the price of the vehicle at the top. Section 179 takes the first slice. Bonus depreciation sweeps up everything that's left. Add the two together, and a qualifying vehicle can be written off almost entirely in year one. But that sentence carried one quiet condition. The vehicle has to qualify. And this is where the tax code gets strange. Because the cars that make the cut are not the ones you'd guess. By the way, if you find this kind of breakdown useful, subscribing helps us keep making them. Now, back to the strange part. Let's put real cars against the rule. A Lamborghini Huracan, low, fast, 2 seats, under 6,000 pounds. The tax code treats it like any other luxury car, so the most a business owner can write off in year one is around $20,000 on a car that costs $250,000. Now, the Lamborghini Urus. Same brand, but it's a big, heavy SUV over that 6,000-pound line. A different rule kicks in. A business owner using it for work can write off almost the entire cost in the first year. Same with a Bentley Bentayga, a Mercedes G-Wagon, a Rolls-Royce Cullinan. Not because they're expensive, because they're heavy. The tax code isn't rewarding the luxury. It's rewarding the weight. That 6,000-pound line comes from something called the gross vehicle weight rating. Basically, how much the vehicle weighs when it's fully loaded with passengers and cargo. It's printed on a label inside the driver's door of nearly every car in America. Below the line, the tax code sees a luxury car and caps the deduction hard. Above it, the code stops seeing luxury and starts seeing a piece of business machinery. And here's the part most people get wrong. In 2026, Section 179 for one of these heavy SUVs is capped at $32,000, and plenty of articles stop right there, as if that were the whole story. It isn't. 100% bonus depreciation stacks on top of that cap and covers the rest. Take a $150,000 Mercedes G-Wagon, used entirely for business. $32,000 comes off through Section 179. Bonus depreciation then absorbs the remaining $118,000. That's the full price of the car, deducted in a single year. Now, before this starts to sound like free money, it isn't. The rules that make this possible come with teeth. First, the vehicle has to actually be used for business, more than 50% of the time, and the owner has to prove it. The Internal Revenue Service, the IRS, treats vehicles as what it calls listed property, which means mileage logs, records, documentation, every business trip written down. And the deduction only covers the business share. Use the car 80% for work, and you can deduct 80%, not the whole thing. Second, the deal isn't permanent. If business use ever drops to 50% or less in the years that follow, the benefit gets recaptured, clawed back, and added straight back into taxable income. The government gives with one hand and keeps the other on the receipt. And third, remember those luxury car caps from earlier? They exist for exactly this reason: to stop someone from calling a Ferrari a company car and expensing the whole thing. The system was built with the abuse already priced in. People call this a loophole. Really, it's just the tax code working exactly as written. The wealthy simply read it more carefully than everyone else does. One more thing, and it matters. This video is a breakdown of how the rules work. It's not tax advice. Anyone seriously thinking about doing this needs to sit down with an accountant first. If this still sounds like a secret only accountants know, here's the part that might surprise you most. It's advertised, openly. Every fall, car dealerships across the United States run promotions built around Section 179 by name. Banners on the lot, countdown clocks on their websites. Buy before December 31st, write it off this year. Heavy SUVs and trucks sell in a year-end rush because the write-off only counts if the vehicle is actually delivered and put to work before the tax year closes. So December becomes the busiest month of the game. Business owners racing the calendar with the tax code riding shotgun. None of this happens in the shadows. It's a routine part of how expensive vehicles get sold in America. And that's just one country's rulebook. Now, imagine versions of this playing out worldwide. So go back to that office parking lot from the beginning. The Urus, the Bentayga, sitting where everyone can see them. The badge is the marketing. The write-off underneath is the machinery. And it was never built to reward the fastest car on the lot, only the heaviest. That's why the government effectively pays business owners to choose the big SUV over the low two-seater. Not because anyone loves SUVs, but because the code draws its line at weight, and the wealthy know exactly where that line sits. Most people spend their lives earning money, paying tax on it, and buying things with what's left. A smaller group learned to read the rulebook first, and let the rulebook buy the car. The car was never really the point. The tax code was.